What is going on, guys? In this video, we are going to be going over the business metrics that we believe are mandatory for you to track inside your life insurance agency. And I would even argue that if you're not tracking these metrics, you are not running a business quite yet. With that being said, if you don't know who I am, my name is Jared. I am one of the co-founders here at AdSystems.io. And what we do is we build out unique paid traffic infrastructures, as well as systems and automations for life insurance agencies. With that being said, the first bit of data that we've come to find that most people do track, but this is pretty much where they both start and stop tracking data, is going to be their CPLs, which is their cost per lead. Everybody typically understands this if they're just buying leads from a lead vendor, or maybe they're working with some type of marketing agency. They have a pretty good grasp as to what their CPLs are. To calculate this is just your paid traffic budget, so whatever you're investing into your marketing, your leads, divided by the total number of leads that you get, right? So if you spend $15,000, let's say in ad spend to acquire 1,000 new leads, very simple math here, that would just give you $15 per lead. Like I said, most people have a pretty good pulse as to what this looks like inside their business, but when it comes to the rest of the data, they have no systems in place to track this. The next section here is going to be called ROAS. Most people have probably also heard of this term. Maybe they do or don't track it, but that's your return on ad spend. And by definition, that's just the revenue that you've earned from your ads based on the total advertising spend that you have. This is going to be expressed as a percentage. So all you're going to do is you're going to take revenue divided by spend and then times that number by 100. Let's say that in revenue from your ads, you generated 35,000. You spent $10,000 in ad spend to do that. You would just divide those two numbers, times that by 100, and that's going to get you a 350% return on your ad spend. Now, when tracking ROAS, what most people, I'm going to assume they would do, if you're even going this far in your business right now, is that you're just tracking from a total spend standpoint. But if you're actually running campaigns, you're going to want to look at the individual ROAS per campaign to figure out which actual specific campaign, whether it's campaign A, B, C, D, which one's producing you the highest ROAS, so that you can just cut off the other campaigns and pour all of your ad dollars to the highest producing ad campaign. Moving on from ROAS, we're going to take a look at two bits of data that we believe here are the lifeblood to your business, and that's going to be LTV and CAC. So starting with LTV, that's going to be the lifetime value of each customer that comes into your business. By definition, that's just the average monetary value per customer to you as an agency owner. In business terms, the way to calculate this is going to be what's called your average order value. You're going to multiply that by the average purchase frequency that a customer has from you. And then you're going to take that and multiply that by the average lifespan per customer that you acquire. To break this down in insurance terms, let's say that the average premium that you sell per month is $100 a month. That would be your order value is $100. The purchase frequency that somebody's buying this from you, yes, they buy it from you one time over the phone, but they pay month to month, right? So your purchase frequency is monthly. They're paying for the product on a month to month basis. And the last bit of data, the lifespan of the customer, let's say they last on your book for an average of 10 months. Obviously, some people churn out and they fall off sooner rather than later. Some people stay on for life, right? Let's say on average, your current book right now is 10 months as to when people are likely to churn out. You're just going to multiply those numbers together. So you would take $100, multiply that per 1 month over the course of 10 months. That would make your LTV $1,000. If you're newer to the space, let's say you're within your first 6 months or so, we would just recommend just to calculate what we call the unique customer value. All that really is just going to be your total revenue that you've generated right now, year to date, and then you're just going to divide that by the number of customers that you've got. With that being said, moving on to CAC, that is your customer acquisition cost. That's going to be your total expenses divided by the number of new customers, and that's going to be measured per unit of time. So some examples for acquisition costs that we see that life insurance agents or agency owners have, that we've also had ourselves as agents and agency owners, are going to be paying for either appointment setters, if you're paying them a wage or a commission. Maybe you have an ad budget right now, paying for leads, or whatever your overall marketing budget and expenses are. Let's say right now you're working with a setter, maybe you're paying them a wage of $2,000 per month. And per month on ads, you're spending $3,000 a month. And through having your setter working, through your ad budget, obviously working those leads, you acquire 25 customers that month. So what you would do to find your CAC is you're going to take that total in spend and cost, which is 5,000 divided by the 25 customers that it got you over the course of that month, and your CAC for that month would be $200. The next bit of data, which we believe is the lifeblood to your success as a life insurance agency owner, is going to be the ratio between your LTV and your CAC. To make this very simple, this is just effectively how much it costs you to make more money inside your business, inside your agency. If we were to take the examples from above, we calculated an LTV of $1,000 and we calculated a CAC of $200. So in this example, our LTV to CAC ratio would be 5-1. And the rule of thumb is that you're going to want to drive this number as high as possible, as quick as possible, right? So again, in the example 5-1, you would be looking for scenarios that you could optimize to get that from 5 to 6 to 7 to 10 to 15 to 20. You'd want that number to be growing exponentially, which is going to increase your overall revenue as an agency owner. So a couple ways to improve your LTV. The first one is going to be increased value. And these are all things that we've done. That's why we can tie them back specifically, these business principles, to running a life insurance agency, being a life insurance agent, and how it directly affects your book of business. So the first way to improve your LTV is going to be to increase the value of whatever you're offering. So what we did personally is we were selling final expense life insurance over the phone to people who typically could not actually afford that product or could barely budget it into what they could actually set aside on a month-to-month basis. So we took that and we then decided, hey, look, let's go increase whatever value, perceived value that we're bringing to the market. And we learned advanced market concepts. So that can be IULs, that can be some type of infinite banking, it can be adding annuities into your repertoire, whatever the case is. By going into advanced markets, you're increasing perceived value to the customers that you're delivering your product to, which in turn, value is going to increase what they're willing to spend with you, because when clients and customers see value, they're more apt to spend more on a month-to-month basis. Let's say it's inside of an insurance policy, maybe you're transitioning into something that's building you cash value. The client, the customer on the other end, is going to have a higher perceived value towards that product. The second way would be simply to just sell more units. And this can be in a variety of different ways. The way that it pertains to life insurance specifically is going to be taking a lead and finding more ways to get more policies into that home. It could be through parents, it could be through children, it could be through spouses. It could also be adding on upsells like accidental coverage or other riders that are going to increase what the customer is purchasing from you, because they're getting more value in exchange for what you're offering them. The third thing is going to be decreasing what's called churn. The way that we do that, and our CRM is actually customized to assist in doing this as an automation for you, is going to have a customer success built-in automation where the client is actually reminded on a month-to-month basis that their payment is coming up. And if they have any objections or questions or concerns about their premium about to be coming out of their account, to reach out to you, right? So that's called client success. And that's an automated sequence that's built into our CRM function. Lastly, in terms of decreasing your CAC, which is your cost to acquire a client, the number one way that you can do that, these actually pretty much go hand in hand, but what we've seen, the number one way that we did that was improving our offer. Again, we went from offering something that it does have utility, but we went up in product to more advanced market products that offered greater perceived utility to our clients. So when there's higher utility that the client sees that they can actually get out of the product, they're more willing to spend more into that product. The next piece would be improving advertising. This is done in a variety of different ways, and this is actually what we specialize in. So over the course of the past several years, we've been perfecting and developing headlines, creatives, copy, winning advertising systems that effectively decrease the resistance of eyeballs seeing your stuff, going through your pipeline, and then converting into new paying clients in your business. So those are two ways that you can decrease CAC, as well as the top 3 ways to improve LTV, which is ultimately going to skyrocket your LTV to CAC ratio inside your business. Again, we highly recommend that what you do is you take the time to sit down, track these numbers, get organized inside your business, and have a strong understanding of the actual metrics that are going on inside your agency, because we believe what you track can grow. With that being said, I hope you guys got some value out of this video. And if you have any questions on having done for you infrastructures for paid traffic, systems, automations built out inside your agency, contact us at adsystems.io.